Hello, everyone, and welcome to our mid-year market outlook. Jim Worden, I'll be walking you through what we're seeing with the markets and the economy. This is all as of August 10th, 2022. So we'll begin this taking a look at economic uncertainty. Right now, there's a big challenge with two big risks that are out there. One is inflation risk and the other being recession risk. So right now, the Federal Reserve appears to be in a game of chicken with containing inflation. And if they raise rates too much, this can certainly push our economy into falling into a recession. If they raise rates too little, this can be problematic and we can have too high inflation for too long. So this is something that we certainly want to keep an eye on. And a lot of people are referring to this as a hard landing or a crash landing or a soft landing. So really we look at this as weighing which is the greater risk. Well, right now, currently the equity markets are weighing that inflation risk is actually the bigger risk that they're worrying about, more so than having higher inflation for longer. And so that is something that we continue to be watching and monitoring. As it relates to rates and the yield curve, there are parts of the yield curve that are inverted right now. We're primarily watching the 3-month and the 10-year yield curve to see if that inverts. A lot of this will be moot point if we already are in a recession. A lot of people are saying that we already are in a recession. And if that's the case, it's quite possible that we're already getting through that recession and we're getting through that. The equity markets are forward looking. And so some of this economic data is already likely has been priced in, but we still need to see how this is going to work through. Here's the yield curve between the 3-month and the 10-year. This traditionally has been very, very good at predicting whether we have a recession or not. And right now we're still about 19 basis points, again, as of August 10th, from inverting and having that 3-month treasury bill actually paying a higher yield than the 10-year treasury. A lot of people have been looking at GDP reports. The last 2 GDP reports have been negative. That has been kind of a rule of thumb that, you have 2 consecutive reports of negative GDP. That means that we're in a recession. That's actually not technically true. The National Bureau of Economic Research is the official authority on whether we're in a recession or not. And the NBER typically marks the start of a recession well after it already started. So we may not find out until we're in a recession until several months after the recession. This is what happened with the pandemic, and this is likely what would happen this time as well if we already are in one. As I mentioned before, the stock market is a leading indicator for the economy, and it may very well could have bottomed in June and could be moving higher, while lagging indicators show a slowdown in economic growth and also a tempering of inflationary pressures. In the past, we have seen large increases in the money supply, being followed by large increases in inflation. So we've seen money supply come down dramatically, and hopefully that indicates that that could be an indication that inflation will also be coming down. We did see that inflation came down from the 9.1% that we saw last month, and it was a little bit below what economists were looking for here recently. So We may see inflation continue to come down. This is what we're hoping for. Now, here's the 10-year Treasury yield. As you can see, there's been a lot of volatility with bond prices. But as stocks and bonds both went down together, recently, stocks and bonds both have gone up together on the potential for slowing growth and a more accommodative Fed. So that just means that if inflation becomes a lesser of a concern and recession becomes a bigger concern, rates would come down, bond yields would come down. That means bond prices would go up. And that's good for bonds, and that's also good for stocks. And you can see here the long-term return for the 10-year Treasury yield. Those yields have pushed above the long-term trend channel. We don't believe that bonds have reversed to a long-term uptrend. So this is something we'll continue to monitor. Rises in rates have stemmed the rise of the red-hot housing market, and this will help reduce some of the inflation that we've seen in the housing market. We've seen the housing rates, mortgage rates, move really, really high, really fast. So this is something that we'll watch this as it relates to mortgage rates and owner equivalent rent. Now, commodity prices will likely continue to be volatile, especially due to the invasion of Ukraine by Russia. These have moved up and then they moved down. If we do have an economic slowdown, these would trend lower, and that would also be good to bring inflationary pressures down. Energy commodities like oil and natural gas will likely stay volatile. And this is also to be expected to continue, especially in Europe as we enter the winter months. If Russia shuts off or limits natural gas, we also need to understand that a push for more electric vehicles will ultimately mean more strain on the electrical grid, which energy is still heavily being produced, electricity that is still is heavily being produced by burning natural gas and coal in many cases. Now, gas prices have come down as the spread between oil and fuel has come down. This goes back to the 3-2-1 crack spread, and this is the cost of converting or refining oil into gasoline. So to the extent that this continues to come down will be good for consumers. That would also be good for inflationary pressures to come down. And that would be good, welcome news. Now, as it relates to the markets, how's the market reacting to the potential for a recession and inflation coming down? Well, it's pretty well. The market would most likely rather have a mild, very short-lived recession than to have persistent high inflation and much higher interest rates, which would bring stock valuations down much further than we saw them come down in June. If we can get above and stay above 43.50, and we're not too far from that, we'll likely have better technical support going forward, and the current rally could have legs to stand on. Now, more recently, we're seeing some good breadth in the S&P 500 with 92% of the S&P 500 members above the 50-day moving average, which is very good sign that it's just not a few companies that are participating in this move upward, but most of those companies are doing that. Now, midterm elections generally have markets that perform better later in the year than earlier in the year. So this year could be one of those years. We've kind of had this market rally here recently, and so that it's possible that we've got that a little bit early. It's also possible that could extend into the midterm election cycle. And this is just a similar chart showing that the bulk of the performance in the midterm election year is toward the end of the year and not the beginning of the year. Now, while markets have moved higher, valuations are still much lower than they were in early 2021. And so this is a very, very good sign that, things are not getting back out of hand in terms of frothiness, and valuations should attract some more buying, longer term buying back into the markets. Good for fundamental long-term investors and institutional buying. Now, profit margins did reach all-time highs and have come down some with the higher inflation, but these are still very high, very healthy by historical comparisons. As you can see here, we hit 13%, and now we're right around 12%. This is still very, very comfortable compared to not that long ago. Our highs were 10%. And so to the extent that corporate profits have got a little bit of a cushion in here to absorb some inflationary pressures and higher costs, this is good for companies. And earnings, 75 to 80% of the companies that have been reporting earnings week by week are still beating their consensus estimates. We'll likely to continue to see some downgrades, but it doesn't look like we'll see the magnitude of downgrades that typically follow an earnings recession, where earnings are often marked down more than 20%. So keep in mind that a slowing in profits is not the same as profits turning negative. Also, some of the companies that have dropped more than 50% or more are starting to show signs of fundamental improvements, not just better valuations. And so that is something that we're seeing as very, very positive sign. In spite of poor consumer sentiment surveys and what we read about the impact of inflation on consumers, consumer balance sheets are actually very, very good shape. Corporate balance sheets are in very good shape too, but consumers are in excellent condition compared to prior inflationary or recessionary periods. So this is welcome news. And while consumers are not saving as much now as they were during the pandemic, all that period that they were saving, they've been able to accumulate, if you will, a rainy day fund that in many cases has been able to help them during this inflationary period. Now, the Goldman Sachs Financial Conditions, U.S. Financial Conditions Index has, this has tightened significantly, but this has come down recently. And so this coincides with the recent stock market rally that we've seen compared to prior conditions where financial conditions were very, very tight. Things are still very, very loose relative to the tech bubble recession that we had and the global financial crisis. So conditions, and even during the pandemic, things are not nearly as tight as they were. And as we look at high yield bond spreads, which is the difference between high yield bonds and U.S. Treasuries, that has come down as well. So that is welcome news. That's something that, in spite of a very aggressive Fed, this has not gotten problematic. And that's largely going to be due to the health of a lot of these balance sheets and the issues of these high yield bonds. Now, while the non-farm payroll increase, the orange line of 528,000 recently was much higher than the 250,000 that economists were expecting. We're looking at the jobs number here and not the number of people working. So that's the orange line. The household survey, or the blue line, is actually the number of people employed, civilians working. So this is the number that can be more important at this stage of the economic cycle. We are seeing some softness here. The Fed has alluded to this as well, and this can bring some of those inflationary pressures down as well. And going back to the whole employment situation, we do know that there's shortages of workers in some places. Structurally, we still have some improvements to make in terms of the labor force participation. There's some areas where we need to get workers back to work and to create those jobs where they have not been able to create them. And so the amount of workers that are willing to go out and work, that number is below where it was prior to the pandemic. So this does take time. We will get there. Structurally, it's just going to take some time. Now, the unemployment rate is usually a very, very good indicator of recessions. And typically this unemployment will spike, coinciding with or leading to a recession. You can see the red lines here are marking recessions. The last recession we had was during the COVID pandemic. And a very, very thin line there. You almost can't see that. And that was a massive spike where we had roughly 15% unemployment, but it came right back down. And so right now we're sitting at 3.5% unemployment. And because of some of those structural issues and because of the higher demand for jobs, we could very well be in a situation where even if we do have a recession, that unemployment number doesn't spike like it normally and typically does during a recession. So this is something that we're going to obviously watch and pay very close attention to. Now, looking at implied volatility as measured by the VIX index, this looks at options. This is still elevated. Recently, it's actually come a little bit below 20. But this is a positive sign. It's likely going to come down further after the midterm election. If we get resolution to the Ukraine-Russia conflict, it may come down even further. That would be beneficial to commodity prices and inflation pressures coming down, and that would be good for equities as well as bonds. Bond volatility is the MOVE index, and a clear showing of the economy will likely rein in the Fed to be more dovish. That's what this is indicating, is that this volatility of bonds has come down, and we will likely see, if the Federal Reserve doesn't raise rates as much as the market has expected them to do over the last several months, and if we see that some of those economic data are softer or weaker than what the Federal Reserve has expected, then bond volatility will come down. That will be good for bond prices and equity prices. Now, this is a really good reminder for all market participants, whoever they may be. It's a good reminder for myself, for advisors, for anyone who's an investor, that we have emotions, and going through these periods where the markets are going down, the markets are going up, there may be feelings of uneasiness, there may be feelings of confidence or maybe overconfidence. This is natural, but I think it's very, very important that we recognize, what those feelings are, and we try not to let our emotions be correlated with the markets, which means that, when markets are going down, that doesn't necessarily mean that we should just get out. And when the markets are going up, that's not always a telltale sign that everyone should be getting most aggressive. But it's important that we understand that, the point of maximum financial risk is when everyone is euphoric about the markets, and the point of maximum financial opportunity and no one wants to invest in the market. So this is a good reminder, I think, for everyone. And the final chart here, anyway, is the S&P 500 going all the way back to 1928. This is helpful to take several steps back and kind of take that big picture view of the long term. When we get very myopic and focus too much on the day-to-day volatility, it can create some unnecessary stress. When we view this from a long term, and this is a regression going all the way back to 1928, we can see that the volatility that we're currently going through is just a very, very small blip. And it's not far from the long-term mean, which is the red line. The gray lines, there's a gray line above the red line. There's a gray line below the red line. Those are the one standard deviation above and below the mean. And the green lines are two standard deviations above and below. So it's important to note that whatever you're reading or watching in the media, that this is the end of the world, things are never going to be the same. The reality is, like, when we look at the markets in the long-term view, reinvesting dividends, and all the way back, this is just a little bit of noise, and it's not going to impact our long-term performance that much. So that is an important reminder for everyone. I would say final thoughts here, I would say that the markets seem to be welcoming in the potential for a light recession or a slight economic slowdown more than no recession and high inflation. We don't want to have high inflation and then the probability of stagflation, which is low economic growth and high inflation down the road, and have this get worse and worse. Inflation may have peaked, but we will need to see some more data to confirm that is finally coming down. The Federal Reserve has a lot of time and data to digest before their next FOMC meeting. They meet in roughly a month. They're going to have the flexibility to raise rates by more. That's bad for the markets if inflation looks like it's stubborn and it's not going away, or less, which is good for the markets. And that's if inflation is coming down and kind of, moving where they would like it to go. This will be entirely dependent on the data. And so we will continue to look at that data, and we need to understand that this data is old. By the time we see it, it's old. So we need to understand what's happening now and today, and understand that the data that we're getting is in the right context. This, is a month old or a couple months old. And to the extent that some things we do have data on, like commodity prices, we know that can impact, what people are spending their money on. And so with that, I just want to thank you for taking the time. Here are the disclosures that we're required to show you. And we hope you have a wonderful rest of your year. Thank you very much.